Hi, I'm Matt Balderston, Certified Financial Planner with Pure Financial Advisors, and this is the Question of the Week. In my last video, one of the topics I mentioned was how you want to use the market as your ally, riding its ups and downs, letting it take you where it's going to go, and that's statistically the best way for you to build wealth. Well, it brought up the question of, well, why would you ride the ups and downs? Why wouldn't you just jump off right when the market starts going down and get back on when the market starts going back up? You make a lot more money. Well, that's the simplest form of a concept called market timing, which we here at Pure Financial don't believe works. And so what I want to do is give you a couple of common sense reasons as to why we believe that. So first off, when you're buying or selling something in the stock market, who's on the other end of the transaction? It's a person that has the exact opposite opinion that you do. I mean, otherwise you wouldn't have somebody buying when you're selling and selling when you're buying. But why do they have that opposite response? You know, we're in the information age. All information is available to all people all the time instantly, so we should all have the same opinions, right? Obviously, that's not the case because we all have family history, we have professional backgrounds, we have political leanings, all sorts of things that filter how we interpret information. And then even though we might be different than the other person, whatever opinion we have, there's millions of people that share our opinions and millions of people that share their opinions. So ultimately all it comes down to is a coin flip as to which side is right once we find out the final result. And why would you want to do any investing based on a coin flip? So hopefully that kind of makes sense as far as why you don't try to get in or out of things at different times. Another concept that you want to think about is, those people that want to invest in something based on something they read in the newspaper or something they see on TV, because it's either good or bad news. Well, there really isn't any such thing as good or bad news in the stock market. There's just news, and it's all relative to what everybody expects. So let's say that everybody expects a company to beat its best profit ever by 100%. And when the news comes out, it turns out they beat their best profit ever by only 80%. Still great news by any definition, but that stock's going to drop because everybody was expecting more. So it's really hard to tell one way or another where it's going to go and how all these millions of people's opinions are going to mix together. So hopefully that makes a little bit of sense. Keep your eyes out for more videos from me and other folks here at Pure Financial. But until then, this has been Matt Balderston, and this is our Question of the Week.